You have now arrived at your destination.
Will, I am so excited for this. I've heard so many good things from Kara, from Semel, from Kanyi, and I finally found someone who's as nerdly interested in venture as me. So thank you so much for joining me today.
I mean, it's a good intro. Every time I listen or every time I see your tweets, I'm like, honestly, I think Harry is the only other one who wants to go as deep and study this as much as I end up doing.
I think it's why I was single for all of my teenage years, to be honest, but it's true. But I want to start with you, Will. So talk to me. How did you make your way into the world of venture, and then how did you come to join Sam and the team at Slow?
Yeah, it's. I'll just tell it to you. I don't know how to describe my journey. So I'm actually sixth generation Bay Area. It's sixth generation Peninsula, growing up around the Stanford campus. So there's like a depth in history that would make it seem more obvious, but to me it was a very out of left field turn. I grew up riding my bike down Sand Hill Road to go play water polo at Stanford. So like there's a sense of growing up like a fish and not knowing what the water is, right? I had very little awareness beyond the IPO market because my dad was an investment banker and was pretty focused on being a water polo player. I like to tell everybody that I majored in water polo at Berkeley and minored in political science. While I was at school, so I swam and played water polo at Cal, had very little time, ended up with an internship. Like the only thing flexible I could do outside of that during summers was help out the incubator there. So I got my first real, what's funny is growing up in Woodside and riding down Sand Hill Road, my first real taste of startups came when I moved to Berkeley. And was just kind of a flexible resource for startups that were getting small grants out of Haas business school competitions. And quickly fell in love with it and swore, coming from a family who had only been on the finance side, swore I would never, that I was going to be an operator. And I just loved it. That first summer I did everything from figure out how to print business cards when those were a thing that were more stock than we could pay for, to talking about software design, product development, and where to go with the limited resources. So I really fell in love with it then. Left Berkeley, became a professional water polo player. Actually, I lived in Hungary for a year.
I did not know that.
Yeah.
Love that. Okay, so you're a professional water polo player in Hungary, living the dream.
Yeah, I mean, it was wild, man. And I wasn't in Budapest. Like I was out in the beautiful countryside, and no one spoke English. That could be a podcast itself. When I came home, it was time to figure out what to do, and I got hooked up with. Have you ever heard of the red herring? Have you ever heard of the red herring?
No, what is that?
Oh man, you're not quite nerdy enough.
Tell me
more. The Red Herring was the TechCrunch of the 90s, but it was a printed magazine. It was like the go-to media resource for venture, for startups, right? Throughout the 90s, and then obviously in the dot-com boom, it became a huge thing. So this is like 04, 05. I sat down with the founder of Red Herring. He was going, hey, media brands are transitioning online in a collaborative fashion. He had a really good thesis actually of like kind of what TechCrunch became. And he said, hey, so I'm going to launch something. Why don't you come do it with me for a year? And so like I said, just got home from Hungary. I said, that sounds great. I want to find a company eventually. I'll navigate. I'll spend a year with you. And the key during that, and so it was total startup, total hustler, all kinds of jobs, building this media brand. But the thing that I got tasked with that resonated the most is he'd promised a top 100 company list back when that was like still a very novel thing. And so I ended up being heavily involved with there being thousands of submissions, having to review probably 1,000 companies. I met with 400 or 500 companies in person over 6 months. I was this 24-year-old kid with no technical background in his first job in a room with KPMG Auditor, all these people who kind of sponsored it to get it. And I just fell in love with hearing the story, right? Having to make a decision, putting it on a list, and ending up having to narrow it down to the top 100, publish it, and then write up the top 10. It was awesome. And I was in that process. I was like, oh, I get it now. This is amazing. And it was really cool. In that group, I think that we called out Pandora as the top company. So we met with Tim and team when it was Savage Beast Technologies, Mellanox, which was a really innovative semiconductor. It was really cool. So after that, I was like, yeah, I want to go pick companies, put money behind it, and be involved in this. So from there, I go, how do you get in if you're not technical? Through the finance angle, ended up with a bulge bracket, tier 2 investment banking job. The key catalyst was going to industry ventures. So when I was interviewing out of banking, I ended up with talking to a bunch of traditional venture funds. I wasn't really a fit, as we discussed, given my background, and found these three partners who had gotten together and were convinced the private markets had changed forever in venture. This was a debate in 06, 07 where companies stay private longer with the public markets open up. And they said, it's changed. It's going to create all kinds of problems, needs for capital that don't exist around the secondary market, later stage market for LPs. Raised a $100 million fund. And it was me and Joey from Allbirds, who was a good friend of mine from college. We were the first two associates. And
I didn't know Joey was there.
Yeah, that's how I got there. Joey called me. He's like, "What are these guys are talking to me?" And I was like, "This is I loved it. I knew it was changed forever. I wasn't sure what happened with the firm. Long story short, I jumped on there, grew that to a couple billion of AUM. Literally did and it ended up being the best thing that could happen in my career. I saw there was no deal we could reject, no sector, no deal too big or small. I looked at hundreds of companies and hundreds of LP partnerships, and it was like a crash course in understanding the realities of venture. With a lot of seniority because we were building. And so by the time I got to my early 30s, I had a track record. I had a lot of context. I'd raised up money from LPs. And so I said, I think I can do this on my own. If I don't do it now, I'm never going to do it. And just as I was setting off to do that, the slow guys who were close friends of mine were taking what they'd done with their personal capital and wanted to launch a long-term venture fund with outside capital. And so I would say I knew what they didn't and they knew what I didn't. It was a perfect match.
It's a perfect union. You mentioned there, though, kind of the confluence of a couple of different things, the public and private, and kind of what industry foresaw in terms of where we were going as an industry. I don't normally start with what the fuck is venture capital, as you know when you listen to the show, but I think this is a really good place for us to start, because you've said before, 95% of venture capital isn't actually venture capital. Provocative statement, tick. Why?
Listen, I think the classical definition, I think there's like New Coke and Coke Classic. Maybe we can talk, we have New Venture and Venture Classic. I fundamentally believe the point of venture capital, right, is to allow a founder to run an experiment against a hypothesis that is knowable, testable, right, where a true answer dramatically changes the enterprise value of the company. If you look over history, that's when it's performed best. And that's really how it works. The scale of it, right, is using a little bit of money to do something that delivers a ton of value over a long period of term. There's a real equity efficiency. That's where the scale comes from. So I kind of start from that being the definition of venture. And I think when you start from there, you'll look and go like, listen, that doesn't scale. So as we've scaled, it kind of inherently, a lot of the capital doesn't fall within that bucket.
It does not. I mean, I just saw a tweet about Bird raising 800 million, now being worth 120 million. You look at Casper, obviously, kind of selling for not venture outcomes, and you see across industries that lack of capital efficiency. Is that what you mean when you say it's not venture capital?
Yeah, I mean, I think it's when we talk about it internally, it's a lot of the money out there isn't seeking novelty, right? They're seeking things they know how to model. They're looking for data they can extrapolate, things, you know what I mean? Things that they can sink their teeth into that are actuals, not theories. So I think you kind of have to remove a lot of that from the venture capital bucket. And then when you layer in the equity efficiency side, I think it's when you're doing really equity and efficient things, that's hard too. So I think when you remove those two qualifiers, you kind of get to a place where a lot of the money, and it got really big, right? And so you get to a point where, 5% of the industry or the capital of the industry, I think, is really seeking out classic venture bets, and the rest of it is piling on into growth, and which is a great strategy. I think we bristle a little bit when you talk about a $200 million round at a $5 billion valuation being venture capital.
I totally agree with you. You said kind of it's a good strategy. You said before, we chatted before, and you said venture's simple but hard, I think was the statement you said. Why did you say that? Well,
I think that formula I just laid out is venture, right? Going into what gets hard is thinking through the risks and rewards of any given experiment a company is going to run, right? Which is composed of a number of different levers, trying to understand, and they're almost always contextual. So it's a simple mental formula. I think having the art and science and the discipline to run through it, to ask the right questions, how to have the context of how to weigh, I know we'll get into this later, or you wanted to get into this later, of like, how do you weigh a really strong value prop in the product versus small market versus a founder without a background in the space. Like that's hard. The equation is simple, but like understanding how to balance those factors and when to make a bet is hard.
We're going to get into that. I do just want to stay on the top level, which is like, and actually, fuck it. Let's go to the conversation that I had with you before this. And I was moaning that we don't have enough rebels in this industry. All the smart people coming out and wanting to get into venture, they just want to go to multi-stage funds. Like, why is that fundamentally? Help me understand. Why do the lack rebels and why do they want to go to multi-stage funds?
I mean, I think there's always been a lack of rebels, right? And so, I think this is a proportionality question. We probably put out the same amount of rebels, but the amount of firms branding themselves as venture capitalists have grown so dramatically. So that would probably be my first reaction is like there aren't that many rebels in society. There aren't that many people who think left instead of right. And I think when you look at what folks scaling need, it makes sense that they would attract people that are less down the rebellious curve. I mean, I've been talking about for a while that all capital games end up looking the same.
What do you mean by all capital games end up looking the same?
So this started as it's all investment banking was the first thing I would say, but I found parallels that go beyond that. When I look at whether it's investment banking, mutual funds, hedge funds, private equity, and now venture, they've all followed a very similar curve where early on in the assets class lifestyle or business model lifestyle, it's subscale and it's volatile, right? And so you have there's no consensus way of how do you make money every year. Nobody knows, right? There's no formula yet or perceived formula. And there's not enough scale where people, it's worth going zero sum, right? You need collaborators. Early on in venture, nobody had enough money. The reason that there was small partnerships who all collaborated and got along really well because like no single firm could raise enough money. And it was still unclear exactly how the formula would play out. So you needed people. So there was a non-zero sum dynamic when it was subscale, volatile, and without a consensus path forward. I think what happens as soon as there is some consensus amongst the players and there's enough scale to warrant zero sum type behavior, you kind of have the same things happen. If you look at the other industries, they've kind of organized on the axis of, are you more zero sum or are you more collaborator on kind of the x-axis, and the y-axis is, are you a generalist doing all the things all the time or are you a specialist? And as soon as you have that kind of consensus dynamic, you need to sprint to one of those strategies and you need to build your organization and asset base accordingly, right? And so what happens in those consensus games is you're looking for less rebels and you're looking for people who fit the organization, right? And can run the playbook that you've laid out.
So if we think about
does that make sense?
It does make sense. I think my subsequent question then is like, bluntly, do we see the denigration of returns in venture in a similar way?
100%. But again, this is like in new venture or venture classic. This is where the definition of the asset class matters.
Well, does new venture not actually disable or disarm old venture or venture classic? Because actually you could say new venture is Co2, Tiger, you name any of the new venture, or actually, any of the solo capitalists or any new model that we've seen over the last few years, that disarms or handicaps traditional venture because in some cases they will take some of the biggest winners, which will then deteriorate the returns of venture classic.
I think there's a real incentive when you're operating at scale to not back novelty, right? There's an increasing incentive. You don't want to conflict yourself out of categories, right? Doing a $3 million seed check, even if the category is 50-50 and conflicting out of a $300 to $500 million AUM opportunity down the line is really hard to do. And being wrong, right? When you're in a competitive industry and you're trying to win deals, being wrong has a penalty. Being wrong and looking silly has a penalty. And so
do you think they were, sorry, I'm deliberately, this is what I wanted because I think me and you both have opinions. Do you really think they care? Like, number one, conflicts. I mean, bluntly, I think the only big multi-stage fund that does care and honor it really well is Sequoia. The rest are like option bets, especially at seed. Me and you both invest with multi-stage funds at seed. They do a lot. They're in competitors. They're option bets for them. And then two, do they worry about them going wrong? Nah, they're seed. I say to them, God, you put 20 million in. And they're like, yeah, but it's a 2 billion fund, Harry. Chill out.
No, they don't worry about the loss of capital, right? And I do think the conflict is real when you screen for founders going, "Hey, you're into." I think it only all the players are getting so big. It only takes two at a table, right? And if Sequoia's got a better widget in that moment, you win if you're not conflicting, right? So I always joke, like I've gone through this with some investment bankers with companies that have novel business models, right? How do you describe them to the street or novel stories? And they end up almost all saying the same thing because their game is relative, right? They don't want to be the one who comes in with underwriting advice that's novel and could be wrong. Like it's the correct thing to say. It could go poorly, right? And so they all kind of say versions of what each other says because to win the next 10 deals, you don't want to be the one who did something that was intellectually correct but worked out poorly. And so I think you end up with the same dynamic inherently at really big, massive firms.
Can I ask, how do you think we as seed managers compete against the new firms and the multi-stage firms coming in as aggressively as they are now to seed, especially with the migration away from growth, when their price sensitivity is so low and they're willing to pay 5 on 50, I've seen multiple times, and I'm shooting it at 20, which is still high.
I mean, I think the question is, are you trying to... The capital game I described is like you want to play the consensus game. You want to go down the path of competing for deal. Like, you believe the consensus game of a certain kind of entrepreneur in a certain kind of product category in a certain kind of market is where returns are going to be generated.
I believe there's a higher likelihood of that happening. Yes.
Well, so that's the first place as a manager that you need to step off of. I think we're in the bucket of no, truthfully, and like you need to step. Like I think we would say we concede the consensus game at the earliest stages. We think our job is to go a click out further on a belief system than in other people. And I think that's a lot of the point of venture classic, right? Is to go out for defensible reasons to yourself, a click farther out the believability curve.
Okay, so let's talk about then a click further out. If we're a click further out, how does our questioning change? You said before that for the most part, investors ask the same questions across asset classes. Does the questioning and underwriting process change when being a click further out from consensus?
100%. Yeah, I mean, I don't know. So I've got like Charlie Munger is one of my religious figures, or on my Mount Rushmore. And I don't remember. It was some point during COVID. I think I kind of in a moment of reflection. I think universal principles are universal. You know what I mean? When you find truth, it carries across the spectrum. And so I was like, I wonder if like all the reading I've done about him and his process, I wonder if I can find a similar vein to how I think the best VCs think, right? Because if you can tie those two together on the spectrum, you probably have found some like universal principles of investing. And I will take heat from this because this is not complete, but I kind of landed on the fact that to figure out enterprise value, which is all we're all trying to bet on what the enterprise value over X period of a company is going to be, right? And how we should price it today. Like that's the job. There's like 5 levers that in my mind that go into that. You're smiling.
I'm ready. I'm just wondering whether I take notes or not.
Yeah. No, so in my mind, there is the arc of history bending this company's way. You know what I mean? Like for the next 5-10 years, do I believe the world will work in such a way that dramatically benefits this company?
Yeah.
That's whether you're a buyout fund, you're right. That's the durability of the cash flows.
Yeah.
Then you get into the product or the set of products a company creates and understanding the absolute value proposition they're proposing, right? And then the proposition relative to the competitive industry. Then there's a question on market, and I know you have follow-ups on this, and then this is like maybe a more debatable topic. I think a lot of TAM analyses like starts off on the wrong foot. I like to ask, and I think the question you want to have about market sizing is most products are built to solve a problem. Most problems are solved, but inefficiently. And so the question I have is like, how much was spent on the problem last year? Or if you're tackling an opportunity or selling consumer goods, how much did consumers spend last year? Right? Like, let's look backwards and figure out how much was spent. And then we can get into the levers of like, why do we believe in the market growth? Right? What do you have to believe that this market grows at 0%, 5%, 300%?
Yeah. Sorry, I'm going to dive in there. That excludes market creation. So for anyone creating a new market where there is no spend, there is no consumer behavior, you will not get to a conclusion if you take that lens.
Yes, you will. The answer is 0.
Well, precisely, but then you would say
Okay.
no to the deal.
No, you don't have to say no to the deal. We haven't gotten to whether we're saying yes or no yet. We're getting to the questions you ask.
Oh, right. Sorry. Okay.
Right. So,
Well, then,
so you can go. But that's an important, right? That to fast forward, like that becomes an interesting discount you apply. And if you discount a deal too much, right? If you get the theoretical enterprise value, these will tell you how to discount it, and you get to a point where you're like, I can't put a price on this. The next question becomes defensibility. I think as soon as you begin talking about a product, there's only a few ways people have ever created defensibility. And I know it all erodes. There's no sure thing modes, but there are higher walls than others, right? Around network effects, intellectual property, regulatory arbs, et cetera. So you need to ask yourself, like, how, if they're creating a novel product, right, in the arc of history with a lot of value and more than competitors in a category I like, why will they defend their market share over time? And then that all comes together in what's the business model, right? Like what's the business model? What's the likely business model? What's the equity efficiency of that business model? What kind of capital is it going to take to produce what kind of cash flows over what period? And so those are the questions that I think. I mean, I think those are at the root of what Charlie Munger asked himself and what Blackstone asked themselves, and absolutely what Sequoia and Benchmark implicitly or explicitly are asking themselves as they wade into how can I price this and do I do this?
so I totally get you. But then are you not asking the same questions that every other asset class asks?
You ask the same questions, right? The nuance is what answers make you most comfortable in pricing it over the rest of the market.
Okay.
So when you think about it, there's really four states of answers to any of these questions. There is statistically relevant longitudinal first-party data from the company. Mm-hmm. There is a depth of third-party data that's highly relevant that you can't debate. There's anecdotal first-party data from the company, right? Early signal. And then there's hypotheses or theories. All these questions exist in one of those four states.
How do you take it a step further? Like, if we take these like questions that we ask, and then we come up with a series of like outputs to those questions, how do we, a click away from consensus, respond differently than they would, given we probably ask the same questions?
Well, immediately, again, using Charlie Munger or a big long-only equity manager in the public markets, like they only bet when there's a ton of first and third-party data, right? That's their job of, this company's been around for 15 years. I think these numbers, right? And their leap of faith is these numbers will persist slightly better or worse, right, than the rest of the market assumes, and their returns accordingly. Can we agree that that's kind of what they're looking to do and how the answers they want and how they think about getting to price?
Honestly, no, because I think with the capital loosening environment that we've had over the last few years, it's meant their reliance on data is less, seen in preemptive rounds, and so they're much more aggressive and willing to pursue the novel because of the proportion percent deployed into the novel being small overall. Do you see what I mean?
I mean, I think when you start at Berkshire Hathaway and work backwards, they have not, right? They in this environment have asked the same boring questions. They want a lot of data. And they then look at it and go, this data will persist in a way the market is not valuing correctly right now. We're going to hit the bid, right?
Yeah.
So you got to start there and work backwards on everything from there, right? Is slightly more speculation on one lever or the other. Buyout funds will go, this company, I think the data will trend more favorably, or we can change some of the data to support more leverage. So then we can go in and price the deal accordingly, et cetera.
Yeah.
To cut to the chase, the job of the venture asset class, even new venture, right, is to come in when there is some, I would argue, classic venture is coming in when there are a couple of those answers, and we can discuss how many when we get to rational and irrational risks, but you're betting on theories. You want to come in when there's a highly credible theory that you have more conviction in than somebody else on at least one of those levers. Does that make sense?
It does, absolutely.
And you want to finance the company to go run the experiment, right? The more you're financing people to take hypotheses and turn them into first-party data, the discount, right? The discount rate of the enterprise value, that's the biggest kick you can get.
I totally get you. So I think that makes sense. Before we move on, I do just want to discuss one of the questions that you
Are we on the right track?
We're totally on the right track. I'm
Okay.
just too. There's so many tracks that I kind of want to take.
Well, this is my issue with me, and that's why I don't share. Is like one track takes 40 minutes, so I just want to make sure.
It's just like you can go in so many different ways.
I know.
I fucked up. I lost money recently because I invested in a company and the founder was world class, fantastic founder. But in a market that hell or high water, you could not make money, and then the business was no longer able to exist. Okay. And I learned actually market wins. Whatever anyone says, it's not primary about founder. Actually, it's just not. If you put anyone in a market that's completely impossible, you can't win. Is what I took away. My question to you is, how do you think about the primary nature of the market over the founder, and how do you assess that? And would you agree with me from what I just said?
What I would agree with is on any one of those levers, you can get an answer that shuts the whole thing down.
We are going in the biggest option tree discussion ever.
But this is why venture is simple but complex. Like, I don't have a pithy one-word answer for you.
How do you feel when I say that? Are you like, no, wrong?
My immediate reaction is I think you failed to create a product that has such easily identifiable value proposition, right? That customers in a segment understood why you were giving them $1 and charging them less than $1. You were giving them $1 value and charging them less.
Yeah, but it doesn't matter. That doesn't matter. What matters?
It does. That's all that matters.
No,
all that matters. Yes.
No, it doesn't, because you're forgetting macro and you're forgetting political. You can have a currency devaluation in LATAM that fucks you in a way that your business is completely unsustainable. You can have a political regime.
But that means that I think we're saying the same thing, right? Like, I think, sure, are there some black swan things that can wipe out every investment? The answer is yes. Like, could you have understood long-term capital management getting blown up by the ruble was going to have an effect on fintech services businesses? No, but like, it did.
Yeah.
So there's black swans. My point, like, one of the things I've gotten really addicted to recently is like the point of the industry and of investing in general is that somebody can manufacture out of thin air value, right, in excess of what it costs them to produce. And the more you can quantify that and make it causal, like if I'm like, hey, Harry, here's $1, I'm going to charge you 90 cents, right?
I'll take it.
You're gonna line up. I'm gonna have no sales and marketing costs. I'm gonna be able to price that right at the line, right? And if it costs me 5 cents to produce that whole thing, I got 85 cents of market. Like, that's magic. And so I do think why venture is simple but complex is like, I do think it's a big option tree, right? But I think at a root of a lot of problems are products that at a minimum have qualitative value propositions that are correlating with a lot of other factors in life. And that makes them really hard to sell. So my first reaction is like, I wonder where the product the founder wanted to build fit on the value proposition dynamic, absolute and relative. But there are some markets that I think at a minimum are really capital efficient, inefficient to go after and not worth it. And no matter how charismatic the founder is, they're swimming upstream hard.
I totally agree with you. Another lesson. We mentioned risk earlier, and it's all kind of part of the decision-making process. How do you think about kind of the risk matrix? Candy in particular told me to ask you this one, but how do you think about the risk matrix and the framework with which you apply risk to each investment decision?
So back to the 5 questions I just laid out. I mean, it's honestly what I do is I go through any problem they're thinking about solving, or especially what they're going to go tackle on the money I'm investing, and try to think about how many of the do I love their answers, right? And then how many of the answers, most importantly, are theoretical versus rooted in some first or third party data. Like, one of the things that's just logical to me is having a novel theory and being correct, having one of them in your life is a low odds proposition. There just aren't that many. Having 2 isn't linear risk, or the odds of being right on 2 vectors is exponentially lower. And I think that there's a point at which you're backing too many theoreticals and you can't put a price on it. It's NPV negative and it's not worth the risk.
Do you know? Sorry, I'm just intrigued. If you think about a situation where you have a theory, a novel theory that is true and correct, you scale a company very successfully. In the scaling of that successful company, you see the challenges of people management, culture management, treasury management, whatever this could be, and you see it in a novel way. Does actually, I'm just intrigued, I don't know the answer here, does it not increase the odds of you having a second novel idea through having the very rare experience that very few people have of the success of the first novel idea? And that's why
I think it absolutely, yeah, no. And all right, again, this is getting deeper. I absolutely think it, I think you can have ideas and experiences such that you do increase the odds of being, there's a winner's edge to life, right? And I think that you can absolutely, by being correct on some novel but right proposition, you begin to understand how to approach and view the world, right? And understand which of those kinds of propositions are more likely to be correct or not. You're operating off better information, both that you're getting from the world as well as you've had in firsthand experience. So I absolutely think, I think you can spot a lot of it in advance. I think you can spot where a success is. So I actually, those 5 questions, I like to think about them as columns when I'm thinking about a company and go, great companies have multiple of those columns that you need to think through. And a lot of times having success on one of the columns actually gives you leg up for doing something, right? For the second S being more true.
I totally agree with you, and I see that. Okay, with like I kind of constantly go back to the idea of like consensus versus one click away. Given that, from a portfolio standpoint, I do also think a lot about portfolio construction and building like anti-fragile portfolios. Is your loss rate not higher given it's one click away and it's less consensus, less down the fairway?
Yeah. I mean,
Okay.
I think everyone's loss rates are really hard to understand over the last 3 years, given the amount of speculation in capital, candidly. But yeah, your loss rate should be higher.
Okay, so your loss rates are higher. So we need more lines in the portfolio. How do we think about kind of right levels
No,
of
you don't
diversity?
need more lines in the portfolio. You need more aggregate optionality. So you can either get that by taking really things that, if they are correct, right, can be massive economic wins, right? That's like one way to offset it. And the other is a more indexed portfolio.
Given they are less consensus and they are more novel, how do they differ on a pricing? Pricing wise over the last few years, when you look at like average entry price for you, is that significantly different from consensus price deals?
I mean, this is like one of the interesting things. It should be, right? If it follows, if I'm intelligently taking more risk than Sequoia, right? Because or name brand firms have gotten really good because they've set their business models. They really look for like one theoretical, or actually like they want most of the questions to have really great answers. And then they find the one theoretical or anecdotal data point and make a bet on it. So yeah, you should get paid more for taking on more risk. I think the market, that wasn't always the case. I think you have a bunch of people for a bunch of different reasons with differing knowledge bases on the game and incentive structures that created a lot of noise around that.
Speaking of kind of the noise created around that, a lot of that, we saw with, a lot of like hedge funds and larger kind of public funds coming earlier. And it just really changed the game in a lot of ways. When you look out at venture over the next like 3 to 5 years, how do you think it looks then? I get a lot of LPs ask me this, and I want to hear your thoughts before sharing mine, because then I can, share your wisdom.
I mean, again, I think you'll find in general. I mean, now I'm going to move the process. I'm going to chat, talking to his friends. Like, you'll find capital gains, they all end up looking alike. Like, I just don't think so. On the consensus new venture scale, right? You can it's instructive to look at what's happened in investment banking and private equity and hedge fund land. Like, I think that's very instructive about where new venture is going, right? I think the pie gets bigger, but unfortunately it subsists less people. Goldman and Morgan are much more profitable than a lot of other investment banks. And so I think you'll see firms that have picked a quadrant and set up their organization and strategy work really well. And the ones who are early and dedicated to that are going to do wonderfully in the new venture game. I think people who have been slow to react to that changing reality are going to have a harder time. And then I think you're going to have a handful of people who pick to play a more classic non-consensus game, right? And some portion of them will do well and some portion will fail to be non-consensus and be right. But I think there's a large middle that I think will need to find a home or struggle to find edge and alpha in the market. And everything in venture is always caveated by like, when there's a massive shift, right? When you have a shift like the internet or mobile, it creates so much margin for everyone that like all bets are off for a little while and everyone can continue to play.
The other hard thing is it takes a while to die in venture. I agree with you in terms of the middle there, but a lot of the middle, we see in the news, they get new funds because they've got, lagging data from 8 years when they had, an IPO that's just come through in the last years. Or whatever.
I think that's going to, I think this period, because the first time, this is the first time we're really seeing a zero sum type behavior and people that can absorb LP dollars in such mass that I don't disagrey with you. Like, I've probably had the same comment for a long time, but like I think we're now in a different era.
Why do LPs do? So I have one of my biggest things that I'd like to change about the world of venture is LP incentives. Mostly it's salary and bonus. If that's the case, you would absolutely give money to, you name your large multi-stage fund with accredited brand, even though you know it's a 1.6 to 1.8x. You would do that every day over a potential 5 to 10x with slow, because you're not going to get fired here and you have no incentive on upside. Thank you, I take this choice. Versus could get fired and zero incentive on upside too. Like, that's what I'd most like to change. Why do you think LPs keep funding them? At 6 billion, you can't return 3x.
I don't think they expect that. I mean, you asked, we didn't get on. Like, I think all capital games are the same. Like, I think when you get to consensus like that, right, people are comfortable and there's a playbook and people understand it. And again, I think a lot of what Tiger did was really rational. Like, yet returns at scale start looking very similar. I think we get to a place on a $6 billion fund expecting 30 to 40% net IRRs isn't reasonable. And I don't think LPs are doing that. I think they're looking, hey, we can say we have venture exposure or exposure to tech equities, right? And 15 to 17% net on a $300 million commitment is meaningful.
I get that. Okay, so it's changing expectations on LP fronts. I have to ask because
I think they're sensitive to the quantum of capital they're able to move. When it comes to IRR, not right. I think that's more the math they're doing.
What do you find the most disturbing trend in venture right now, Will? What worries you most? You sit with Semil, got a nice bourbon. What are you going? Oh, Semil, fuck.
I'm more optimistic than that. I had a hard time. The transition to competing to win deals versus underwriting, right? There became a real premium on, hey, this is something everyone likes, and so I better set up my widget to go compete for that deal versus I've got 3 bullets to shoot, right? I mean, the way there's a hunting analogy I loved, which was for a long time, venture was about, are hunting analogies okay? Or are those going to be not land at all?
Oh no, totally land. Yeah.
All right. So for years it was about elk hunting, right? You had expensive bullets. You'd go on a long walk through the woods. You'd learn over the years how to get signs of an elk had been here. You'd be really patient. You'd lay there. You'd call them. One would come. You'd make sure you had a clear shot so you didn't waste a bullet. And if you got it, you took down a lot of meat and you were fed for the year. There, for a host of reasons we discussed, that as bullets became cheaper, the incentive became shoot at anything that moves because you'll get another bullet. So even if you get a squirrel, it's okay, right? And then it became such a relative game that everybody was hunting in packs and just trying to be in position to be the first to shoot at the thing moving. Does that all make sense or sound crazy?
No, it totally makes sense.
And so I think that's the trend. I think it done successfully on a low capital base, it's elk hunting.
I totally get you. Do you think venture is, you said about kind of the movement to packs there, do you think venture is more or less collaborative than ever? Because
new venture is less collaborative than ever, and the incentive structure is to be less collaborative.
Why do you say that?
Because once there's a game plan, like you just want to do all of it.
Okay. And
When you have at the upper ends, when you have all the money and all the products and all the strategies and all the sectors, you don't really have a need to offlay risk, or right, the risk doesn't seem that high that you need to offlay it with another partnership, and you don't run out of money at taken to its extreme. So there's no real incentive for collaboration.
venture classic, is it more collaborative or less?
Yeah, absolutely, because you're dealing in lower quantums of overall money and higher risk pools.
Do you think so? But because of that, you need more ownership. Higher risk pools mean you need more ownership unless you're going for the spray and pray.
I mean, that becomes, are you going to put 10 bets in the fund, or are you going to put 50 in the seed fund, right? And you can make a case for both.
Which do you go for?
I mean, it's slow. I think we've learned a lot and respect what Josh has built at first round a lot. So we're in there's enough risk in these things, and the upside of winning them is dramatic enough that we want to be collaborators.
Listen, I totally agree with you there. Can I ask, on the price sensitivity, it's one where I've made the biggest mistakes often. How do you reflect on your own price sensitivity today?
I mean,
especially,
it's so hard. It's all mistakes.
what do you mean
Right?
it's mistakes?
Because when it wins, you don't look at your pricing and be like, oh, I really nailed it on pricing. Right? And the only time pricing really screws you up is when you stay disciplined and miss a dramatic winner.
True. I've had wins before though where I go, oh, great, but I did get in at 60, and it's like, it's $1 billion, and you're like,
well,
oh.
I mean, I think like maybe I'm not operating on like the right magnitude scale. Yeah, I mean, what's one of the biggest mistakes you can make as an early manager, right? It's like you put $2 million to work at a seed price. Don't know what the stage is, right? You put $3 million to work for 10% or for 15% ownership in something super risky, and then you put 100 grand into something at 150 post that's less risky, right? Like that's more of a portfolio management mistake. Like what I would say to you is maybe you got priced wrong, but what you really got wrong was allocation.
Yes, but it didn't fit into the portfolio management strategy of then like concentrated bets and stage, and so it was misaligned. This is where there's like, this is what I love about venture though. There's so many levers. Do you know what I mean?
And it's what you see. Keep saying we go down all these option trees. It's like, yeah, you're balancing a lot of. Every time you're looking at a hand of blackjack, you're doing a lot of mental calculus trying to figure out how to balance everything going on, which is really wild.
Well, what's been your biggest hit so far? And what did you learn from it?
It's a great question. I can only think of my issue is I can only think of the things that I was like really in the weeds on right now, and all of those are seed stage and not cranking. I mean, the one I loved the most, is that fair? Like, I mean, I was lucky at industry to be able to be invested in a bunch of the Alibaba and Twitter, but those were buying stock later and being right. Like which was fantastic, right? So I was lucky enough, there's a company called LiveRamp that Oren Hoffman founded that I was lucky enough to lead the Series B. And this was at a time when ad tech related products were kind of written off, right, as hard to differentiate, hard to find novelty, hard to find defensibility, and really dug in with Oren to understand the business and the potential. And we led the round. It very quickly was I forget, 10 or 12x within 2 years on acquisition. And then it ended up swallowing the public business that it went into. And now is publicly traded at a couple $1 billion market cap. And
so what did you learn from that?
Well, the learning was to sift through all not come to sweeping conclusions, right? To sift through the business and think through the problem they were proposing solving and how they were thinking about building a scalable unit to deliver value to their customers, right? They had come up with a really novel way so I think that was like the very tactical learning I took with me, is to like really think through those, get to the customer, who pays, the defensibility dynamics.
Well, that for me is a fundamental differentiation though in venture though, which is like, the truth is I think venture investors are some of the laziest people on earth, where they go, ad tech, Terrible, awful business to be in. And they don't sift through the data. They don't look for the beauty in the broken, which I'm sure there was broken elements of any business, but they don't spend the time to go 3 layers deeper and actually see whatever beauty there is within that business. It's like, ugh, healthcare done. Ugh, ad tech done.
Yeah, no, I guess the way I would say it is, and again, this is tooting my own horn, but not, or like hitting on the same framework we've discussed, is like, I don't think enough investors think of themselves, or enough venture investors think of themselves as an investor first and then venture second. I don't think a lot of people think venture is some art that is unrelated to what a great public equity manager does. And I think when you invert it, right, you think, what am I looking for? What are the characteristics? What are the questions I'm asking? It'll take you into much more interesting places consistently, and give you a framework to double click, dig in, and process things. I think more consistently and bring some objectivity to the subjectivity.
What's the biggest miss, and what did you learn from that?
Maybe there's a lot of miss. I mean, I've been dealing with this for a while.
It's really embarrassing.
We were very price sensitive on deal, and that was a bad idea.
On deal, like DEEL.
Yeah.
Yeah, so was I. Every round, Alex came to me, and I thought he was amazing.
We were negotiating to be the lead of the seed, and literally were like this far apart, and decided that was too far apart.
So what did you learn? That was a bummer. What did you learn?
It's hard to have this is the hard takeaway about price, right? Which is like, it matters till it doesn't. So I don't know that I have a good core learning that you can take and extrapolate and use over and over and over again.
I think one thing that I learned from one of my failures, which was an interesting one recently, was that internal mindsets around goal orientation are much slower to change than strategic decisions to change them. And what I mean by that is, we as a company need to optimize for capital efficiency on a per basket basis. Changing to that mindset from growth is impossible overnight. When you have 100 people, there is a significant time lag between strategic decision made and employee mindset and how they focus and prioritize. It does not happen overnight. It's 6 months.
Absolutely.
I didn't anticipate that.
The lens I use the most, that's the most helpful to me as like a career finance stock picker person who hasn't worked in one of these large orgs and understands it's a major blind spot of mine, is to try to figure out what part of the organization is in special forces mode and what part's in infantry.
What do you mean by that? That's fascinating.
Founders are special forces. Founders are operate with lots of subjectivity, and I like to think, go in and you kind of go, yeah, I've got a set of tools, an objective, no real path to it. Like, I always go, you send the SEALs in when you're like, go secure that town. Jump out of an airplane with a couple different weapons and a plan you come up with yourself, and call us when it's secure, right? And they do an unbelievably effective job at it, more so than you could do with 1,000 people put against it, right? The cost of that output is dramatically different. Once you've secured that objective, building fences and putting supply lines in and thinking about troop movements and how many Humvees you're going to need, that's a totally different skill set than special forces. Does that make sense?
It totally does.
Well, special forces, they're like, yeah, tell me loosely the thing to do, and I'll call you when I'm done, and I'll get it done well.
And so you need to understand that when investing in a company in terms of what parts are which. Help me take that one step.
Well, I think when you're running when you're running a company, I think one of the things I talk to founders about is like, you need to understand any given objective in the company, where it stands on kind of, I always say 0 to 1. The first time you do something needs to be done by the leader of the SEAL team. Doing it the next 10 times, the SEAL team needs to manage it, right? It's special forces managing special forces. But doing it time number 11 through 100 is when you want to bring the infantry in. You want to bring people who love, embrace, and have a depth in process, repetition, right? Refining the standard deviations of outcomes in any given entity, et cetera. And so I think it's a really great awareness for where you are on a skill set. Do you have both skill sets? Do you love one skill set over the other? And then where are you as a company in terms of that repetition, and what do you need to bring in?
Sorry, I was reminiscing on my own like mistakes in life when I was listening to you there, and I'm using this as like with the show I just use it for like advice. Another fuck up I had was I fucked up on selling secondaries and when to get out. Last year I had a chance to get out on a load of different options, investments, and I didn't. I always believe the hold on to your winners, hold on to your winners. I should have sold. Um, I really should have sold. How do you think about secondaries? When's the right time to sell? And how would you advise me, Will?
Yeah, and I got to give my partner Sam credit on this one. I mean, I think we're all learning literally anyone who's gotten skin in the game in the last 10 years is like learning the same lesson you are, or just you jumped in it a couple years after people. This might be one of the more controversial things. I'm not sure it's ever healthy to be in hold mode. I don't think you should ever mentally be holding because one, selling is really hard. Selling is emotionally hard. It's intellectually hard, and it's structurally hard in illiquid assets. So being in hold and then reacting is wildly difficult. Uh-huh. And so we've kind of adopted this mindset of like, I think you either are a buyer. Now you may not have the capital or the right cost of capital, but I think you either see signals that tell you would continue to accumulate, or you should mentally be thinking about selling. And that doesn't mean you sell tomorrow. That doesn't mean you sell 3 years from now, but you begin to build a mental framework of, hey, I've gone past the point where I'm comfortable adding, right? What would it take? How would I get out? What would my logic be? And so again, I'm always looking for things you can do over 1,000 hands of blackjack. And so that's become a really interesting way for me to like take action consistently. Knowing that, I mean, I think the other thing you can do is like at a certain point of fund return, right? You just sell secondaries, which is a great heuristic. It's served a lot of early stage investors really well. Though I do think you may cut off the tail on some things that were obvious holds or things you would have still been, you know what I mean? If you go through this lens of, is the business generating answers that say this is going to continue to compound or has price gotten ahead of itself?
So I totally am with you on the like hold is like a weak position to be in. I kind of align it to like pro rata, which is I think pro rata is really lazy. I'm either like fucking aggressive to put money into Will's company or I'm not. But I think that
I think starting from that mental position is like a really helpful way to start thinking about secondaries and liquidity, et cetera. It's like, again, I don't have magic bullets. I'm intelligent enough to know I don't have all the answers and there's lots of nuances. So I have a hard time with one size fits all, but like that's been a key learning of mine in the last year. That's been really fun to back test. And it changes how you view things.
How do you think about reserves? I think reserves are going to be very different moving forwards. Before, if we didn't take our reserves, no one gave a shit. There was so much money. It was like, oh, you'd almost fight for your reserves. Like now, I think we're going to see a completely different environment around reserves, how future investors see us putting in reserves. How do you think about that today, especially moving forward?
I mean, I understand the two camps who are like, put low cost basis things in there, keep your absolute valuation low, add up the number of call options, don't do reserves. I understand that logic. I also think if you can get disciplined about your underwriting, right, I think you increase the overall capital you can return. And so
there's the opportunity cost on that capital, though. This is what I have, which is like, yes, I had this the other day, which is like, yes, I've got a great company, but I'm going in again at a 300.
Yeah, but this goes down to what's your opportunity cost, right? If you have limited partners, right, who are supporting, this goes to your cost of a bullet, right? Back to cost of a bullet.
Sure.
If you're somebody that's confident in your cost in a bullet, right, then you'll use it in attractive situations, even though it may be in 10x and not 100x. Right. Sure. And understand that. So I think that's one lens to bring to it is how expensive is this bullet, which is very manager. It's GP specific. It's fund specific. It's firm specific. That answer. And I do think you can get disproportionately good at underwriting. Like I think in companies that are really important and high quality. Now the question is, how good can you be at being honest with yourself and looking for those? you're almost always better off accumulating stock in those companies over the first 8 years of their life than you are in any diversified venture portfolio, right? So like I would just posit that those are the two extremes. And I think it comes down to your own opportunity cost of capital and what skill set you think you've refined the most. I mean, this is something we've talked about. And like one of the reasons I initially got involved in Slow, back to I was good at things they weren't. I'd spent my life at B, C, D, right? At that kind of later stage. And so it was this interesting lens to have somebody who was more comfortable underwriting that stage of asset in an early stage partnership.
Tough question. What firm do you admire the most?
Sequoia. Not even tough question.
Why?
I think it's one of the most well-run businesses. I think it's a top 2 or 3 investment management firm in the world, and one of the most well-run businesses that I can see. I think they do. I mean, back to like my 5 questions on enterprise value, like, is arc of history in their favor? Absolutely. And it always has been. Will the world work in a way that's advantageous to them going forward? Yeah, I think absolutely.
Do you agree? So I'm totally with you. I would have said the same. It's annoying because I often agree, and now I try and be more different. I agree. But I always think like success in venture is cyclical. Do you agree with that? It's like, great firm gets great company, which leads to more great entrepreneurs wanting great company. It's this self-fulfilling flywheel, I often think. And I said that to Doug Leone when he was on the show, and brilliantly humbly, he was like, I would love that to happen, but people don't just go, oh, Doug, here you go, take my unicorn future company. Yeah, it's a fight.
Yeah, no, and that's what I really admire. I don't think that's what's made them special, and I think they're extremely. So I got really lucky. Don Valentine was a contemporary of my grandfather's and was a friend of his. And early on, I got to spend my grandfather passed away when I was young. It's a longer story, but I asked my dad. I said, "Do you think when I joined industry, I was just get at a no-name firm, right, coming out of the left field?" And he spent some. I got lucky to get a couple one-on-one sessions with Don Valentine back in the day, and it was clear from that get-go that they looked at it. They looked at this as a product and a business, right? That they came at to this that this wasn't a purely subjective artistic endeavor that was kind of up to your ability to read tarot cards, right? Like he understood from I think if not the get-go, very early on, that this was a business that you needed to ask those questions that we talked about earlier of yourself, come up with answers that are theories are real, and execute on them. And so I think they've had that DNA from the get-go to really think about, is the arc of history in our favor? Do we need to create new product sets, right, that create absolute and relative value? Do we have a sense of what the market size is going to be? What are we betting on? Have we thought about how we continue to defend ourselves, right? And how does that come? I implicitly or explicitly, I think they take that level of or that view of their business, and they do a great job of continuing to innovate, add S curves, right? Back to great companies. They continue to add a column to their business very intelligently, or revisit a prior column and realize that the defensibility may be going away and they need to add to it. So I don't think that's who we'd want to be. Like, I don't think we have the DNA to aspire to be that, but when you go, who do you admire and who do you learn from the most? If you're not saying Sequoia, I'd have a long debate over a beer.
I totally agree. I think you're insane if you don't. Final one, I promise, and then the quick fire. What do you want to be? Like, often people ask me, like, Harry, 20 VC, go many directions. Where do you want it to be? I know my answer. Where do you want Slow and you to be?
That's a great question.
Do you want to do multi-stage? Do you want to do?
No, I mean, my answer, and I don't speak for my partners because we're the same wherever we sit down and revisit who we are, who do we want to be, where do we go in the world. I mean, I think early on, I think we would have said multi-stage. I think the amount of human capital and what it means on a daily basis to be a competitive multi-stage firm is not what we do. It's not our strength. It's not our DNA.
It's also a different life. I think this is what people...
100%, right? And again, capital gains look the same. Like, you need to be the same way in certain bankers or private equities get on a plane at a whim because you need to go deal with it, right? Like, there's certain realities to running that model really well. I thought it's really interesting if you can marry being a very good venture classic craftsman, right? If you can sit and consistently think through non-consensus intelligent bets, right? That are risk adjusted in your favor, and then have an element of being a collaborator, right? Going into the consensus game as a generalist collaborator, right? Someone that in that function brings value not only to the companies itself, but also the other venture funds and general partners in the world. And it's not a perfect analog, but I often look to Allen & Co. as someone who's done that really well, where when they're involved, they actually play a unique role even when another bank is at the table. And so I've always been really intellectually curious to see if you could bring that model to bear in venture, where you marry a classic venture practice with a generalist collaborator model.
Well, we're going to do a quick fire round, otherwise I could talk to you all day. We should do this with tequila next time. Tell me, what's your favorite book and why, Will?
Professionally, it's The Success Equation by Mike Mabuszian. No full stop. Everyone in venture should read it. It changed how I operate day to day.
Who's the most underrated angel in the ecosystem and why?
Mark Goines. Why? Mark, to me, I never worked with Bill Campbell. I mean, so Mark was at Intuit back in the day, was a VC for a while, and now kind of plays the independent advisory role for founders, especially in fintech. And he's just an amazing mix of, he understands the investor lens, the investor ecosystem. He understands organizational challenges. He has founder empathy, and he's got very independent, tactical, logical advice across the spectrum of what a founder might encounter.
What happens to Tiger from here?
That's a very loaded question. I think they retrench, probably at slightly smaller scale on the private side. The public book, I don't know. There aren't not a lot of public books that have recovered from being down that far, but they're kind of an unprecedented institution in general. I think a lot of what they believed was right. I think they probably were putting out maybe too much capital or had too loose a filter. But this idea that companies very quickly become growth stage, right, where you can take the data and model it, and once you kind of feel comfortable about the standard deviation of outcomes, build a portfolio around it, I think is correct. And so I think it's probably a smaller quantum of capital, at least on an annual basis, but that the overall hypothesis was largely correct.
What would you most like to change about the world of startups, Will?
I wish founders slowed down before they ran out the door and really understood why they were, where do they have unfair insights in the world? What's their theory on building a product with value? What's the right capitalization path? That's probably the biggest thing. Like, venture to me, as I've made clear, is a very specific product. And I think a lot of folks seek it that don't necessarily need it or are not a fit for it. And so I wish there was just more of a universal understanding of what calls for venture and what doesn't. I think that would save a lot of time and heartbreak for all parties.
Penultimate one. What have you recently changed your mind on?
That's a great question. I've gotten really fascinated by branding.
Really?
I think
you should apply it to yourself, Will.
I should. Well, so applying it to myself is interesting, right? Which is, we went through a period, at least in my venture career, where everyone spent too much money on branding too early.
Yeah.
Right? There was, hey, we're going to seed round, we're going to take $350,000 and go work with someone on brand identity, and a brand plan. So the hard pivot away from that was like, don't brand, SEM, right? If you're going to spend marketing dollars, have it be performance oriented, lots of tough metrics. And which made total sense to me. I think we've over rotated. So I've changed my mind that branding is more important than I thought it was. And
for companies or for funds?
For companies, sorry. I mean, for any company, and a fund is a company.
I agree.
And I've gotten really fascinated, though, about the right time to lean into branding. And so I've changed my mind that it's really important. I've started sending more founders to meet with branding specialists, but I'm trying to really understand. I think there can be a magical moment, and it's different for each company. And for me, it has a lot to do with value proposition, because I think that's the core atomic unit of any great company. And I think there's a point at which you have enough case studies, you verified that you actually create a lot of value in the market, and continuing to go through performance marketing, which has diminishing returns, is probably not the highest operating leverage way versus getting brand and brand awareness right and going for more subjective soft ROI spend. I don't have an answer, but I've changed my mind and I'm fascinated by it.
Do you think VCs do branding well today?
I think successful new venture, absolutely. They're great at it.
Who would you say is great at it?
I mean, anyone outperforming. I mean, I think Sequoia does great. Andreessen does great. Benchmark in their own way does great. Founders Fund does great. Like they've all made really great, I think, intentional branding choices.
A final one for you, my friend. What was the most recent publicly announced investment, and why did you say yes and get so excited?
That's so hard. Oh, well, can it be a follow-on? We haven't done many new investments lately.
Whatever it is. When was capital out the door?
One got announced yesterday, which is Fair Square Medicare.
Okay.
And we got excited for a couple reasons. One, it was a founder who was just executing, right? It's been a space. So he's starting in Medicare brokerage with the idea that you can bring much more transparency and a more 2022 buying experience and take a ton of market share in that way, in a high operating leverage way, and outside of a traditional call center brokerage. And he was just, so yes, logically, is my mom going to buy Medicare different than my grandmother did? Absolutely. That hadn't been mixed up. And there were a few startups that went after it, Chapter and some others. And Daniel was just executing. So we continued to pour money in. He just announced a round from Lynn at Define, Lynn and Chirag at Define. What was really interesting to me is I in digital care, I think the way you're going to everyone's going to have a digital care platform, every demographic, where you deal with a lot of your health issues there. And then you bridge that with the offline world. I think the way to get there with seniors is to start, what's the most common problem they all have? Making sure they transition to the right Medicare plan. And so what got me to a yes was a guy delivering value, executing in the markets, who had several S curves that I thought were pretty logical ahead of him.
Well, listen, this conversation has taken many twists and turns. I would love to go for a drink. I think we'd have much more fun with the tequila in hand. You are a star for putting up with my wayward turns, but thank you so much for doing this, man.
Yeah, man, this was really fun. Like I said, coming on your show teaches you a lot about what you think.